Welcome everyone. Thank you for joining me. The Federal Reserve is about to make its most consequential policy move of the entire year. The Fed is widely expected to begin cutting interest rates by 1/4 percentage point and possibly deliver something even bigger, an early end to its balance sheet tightening program. In plain terms, what does it mean? It means the Fed might stop shrinking its massive $6.5 trillion pile of assets, and that could give markets a lot to cheer about. In today's video, we're going to look at the big picture and decipher the challenges that the Federal Reserve is facing. We will focus on liquidity and the central bank's next move. For nearly 3 years, the central bank has been engaged in quantitative tightening, or QT, which is gradually reducing the size of its balance sheet by allowing bonds to mature without replacement. This was meant to unwind the massive bond buying programs that began in 2019, as many of you might recall, when the Fed ballooned its balance sheet to nearly $9 trillion to stabilize markets. But now, with liquidity in the financial system thinning, and signs of stress emerging in short-term funding markets, the Fed appears ready to hit pause. The decision comes as the broader economy sends very mixed signals, and I frequently discuss this in my videos here on my channel. According to official reports, inflation has cooled, with core services prices easing. Now, let me know in the comments if this is something that you do see in those areas where you're located, where you live. Has the inflation cooled? Has the rate of inflation cooled? Let us know in the comments. Meanwhile, job growth is slowing, and this is according to private payroll data from ADP. Even though the government's official numbers are delayed because we're now in the 4th week of the shutdown, markets are confident, they appear to be confident that the data would tell a very similar story. After the expected rate cut this week, there is nearly a 90% chance of another cut, of another one at the December meeting, which would bring the benchmark rate down to a range of 3.5 to 3.75% by year end. I would like to point out that what happens with the Fed's balance sheet could actually prove even more influential than the rate cut itself. The Fed has gradually reduced holdings of treasuries and mortgage-backed securities that it bought during previous periods of stress, when its primary goal was to tamp down interest rates and to support financial markets and the economy. For months, investors have watched as liquidity in the system has quietly drained away. If you've been following these reports this month and the previous month, you may have noticed that banks and other financial institutions have been looking for more cash than money markets had available to lend. And so that situation is actually pushing up overnight interest rates. The secure overnight financing rate, which is a key measure of short-term borrowing costs, recently spiked. And this was a sign that reserves in the banking system are no longer abundant. Analysts from Goldman and other institutions now argue that reserves have fallen from ample to merely adequate. And that is a polite way of saying money markets are getting very, very tight, and funding conditions could soon become unstable. The tightening in liquidity isn't just theoretical, by the way, it is visible in the data. Since the summer, the Treasury General Account, essentially the government's checking account, has risen by over $600 billion, draining that same amount from the financial system. The buffer that previously absorbed QT, the Fed's reverse repo facility that is, has been nearly exhausted at this point in time. And so as a result, overall liquidity is now at its lowest level relative to the banking system since 2020. And that is very, very worrying. That should be a concern. The last time that funding markets seized up in September of 2019, overnight repo rates spiked violently. It was a really rapid spike. And that episode now may be remembered as Repocalypse. Some of you may recall that too. The Fed doesn't want a repeat of that situation. And that is precisely why many economists think that Jerome Powell will end QT now before things start to break. Ending balance sheet runoff would help stabilize funding markets in a short period of time. With less treasury supply draining liquidity, liquidity, and with money market funds still flush with cash, short-term rates could actually settle down. Some analysts even think that the Fed might lower the cost of borrowing from its standing repo facility, which is its key emergency lending tool, and they may do that to calm markets even more. If Powell does all of this, it would actually mark a quiet but very powerful pivot. The Fed would move from being a passive drainer of liquidity, if you will, to a steady supplier again, and not quite full-blown quantitative easing, but close enough to effectively be in a position to boost investor confidence once again. Now, looking ahead, most economists expect the Fed's balance sheet to grow gradually in line with nominal GDP, about 4 to 5% per year as part of nominal reserve management. And that means even without crisis-era stimulus, the Fed will remain a dominant buyer in U.S. Treasury markets. So what does all of this mean for investors and for you? In the short term, the Fed's shift should give markets a little boost. And of course, we will see lower rates, more liquidity, and a central bank effectively signaling that it is ready to support smooth market functioning moving forward. But the real question is whether the Fed is simply managing liquidity or if it is preparing for the next phase of monetary easing. Because if the economy softens further in early 2026, the distinction between reserve management and QE might not be too visible. It might not matter too much. Regardless of the exact level, analysts say that it would be in the Fed's interest to stop soon to avoid the risk of a more severe market disruption. Next year, the Fed might need to start purchasing securities again, either to top up the level of reserves if they have indeed fallen too far, or to simply keep the size of the balance sheet proportional with the growth in the market and the economy to continue ensuring that there is enough cash in the system. Now, let me know what you think, what you anticipate the Fed will do in the short term. I would love to hear your thoughts and your predictions in the comments below, as always. Thank you very much for watching. I appreciate you being here. I hope that you consider supporting my work. It means a lot. Become a subscriber on YouTube, on Substack, and Patreon. You will find those platforms linked in the description below. And I will see you here tomorrow. Bye for now.